Hello everyone and welcome to the BDO Financial Reporting Update webinar for September. So I'm Elisa Noble and joining me today for this webinar is Anthony Appleton, and we'll be talking about a few things with I guess an overall focus on narrative and sustainability reporting this time around, simply because that is the area where we're seeing quite a lot of developments at the moment. We will start though with a brief accounting update. As part of narrative reporting, we'll be looking at a number of recent reports from the regulator, the FRC, highlighting where companies can improve on different aspects of their narrative reporting. So we've picked out some of the key points from those and we'll share those with you. Anthony will be talking about a few different aspects of sustainability and climate change reporting, including latest thoughts on where to improve streamlined energy and carbon reporting and how to get ready for TCFD disclosures, which are coming in firstly for those premium listed commercial companies this year under the FCA's listing rules. And we'll finish off with a reminder about ESEF or electronic reporting. So I should have said, sorry, before we move on, is that if you do have any questions during the webinar, then hopefully you're all familiar with the Zoom functionality. And please could you use the Q&A function, and we will try to answer any questions during the course of the webinar. Have a colleague logged on who might be able to answer them in the Q&A function, or we might answer some of them in person, or alternatively we could get back to you after the webinar. Of course, you can always get in touch with your usual BDO contacts as well to discuss anything. All right, so let's take a look at what's happened in the world of accounting. And there has been a little bit of a summer break, so we don't have any new changes to UK GAAP or IFRS to tell you about. But for UK GAAP, the FRC has started out on the next periodic review of UK and Ireland accounting standards, including FRS 102. And so what they have done to begin with is request views from stakeholders. So that means that there's an opportunity to send in comments. So if any of you would like to get involved, you can do so up to the end of October and tell the FRC if there are any parts of the standard that are proving maybe difficult to apply in practice for your business. Then you can send in comments or get involved in, I think there's a series of roundtable events that the FRC is organising for different stakeholder groups to gather feedback. Typically what they look at in this type of periodic review is consider what has changed in the period since the last review. Are there any significant changes in the business environment, in types of transactions that now need a change in accounting standards? And they will also consider any changes to IFRS. They won't necessarily be reflected in FRS 102, but it's something the FRC will consider, whether anything that's changed in IFRS or the wider reporting framework should be reflected in UK GAAP. There will be a public consultation with any proposed changes, expecting that next year in 2022. And currently, the likely effective date of the revised FRS 102 standard would be 1st of January 2024. So that's still some way in the distance, but as I said, if you do have any thoughts on something that's not working or something you'd like to change, then this is the time to raise those views. In the world of IFRS, similarly, we haven't had any specific major changes to standards just recently to share with you. So we thought we'd take the opportunity to highlight a few sort of broader, longer term projects that are out there. Many of you do like to have a bit of an awareness of what's coming up in the future potentially. And so there have been a number of exposure drafts where the IASB has been looking at changes. And 3 of these to highlight there on the screen. One is management commentary. So this is not something we have adopted in the UK, because for UK companies, we have our own legislative requirements, the strategic report, and the FRC issues guidance on those. But you may or may not be aware that there is in fact a practice statement under IFRS which guides companies in how they put together their management commentary. In many countries might call this MD&A as well. So how you would do that. The previous version of that is more than 10 years old, so they're looking at an update to that, because the last 10 years has seen significant changes in narrative reporting around the world, including the increased emphasis on sustainability reporting. They are also looking at disclosure requirements in IFRS standards overall. So this is basically to address the situation where I think everyone has heard the complaint that nowadays many annual reports and financial statements are very lengthy and include a lot of detailed disclosure, sometimes perhaps too much clutter. So among the proposals for how to address this is to introduce an approach which focuses more on disclosure objectives rather than specific items of information to disclose. And that's what these proposals are looking at, with a focus on what information investors want. And they have also, basically what's happening now is this approach has been tested with 2 standards, IFRS 13 and IAS 19 in fact. And the IASB is trying to get various preparers out there to get involved in field testing the proposals to see how the new types of disclosure requirements for fair values for pensions would work in practice. The UK Endorsement Board in the UK is also involved in looking into this field testing in the UK and coordinating, I believe, some of that. So if any of you are interested in how this works, maybe if you've been particularly frustrated with fair value disclosures in the past or pension disclosures, then this is an opportunity to get involved in that and share your thoughts. They're also looking at something that might be a bit similar to our UK FRS 101, so a new standard for subsidiaries so for example, subsidiaries of listed groups, so subsidiaries without public accountability, to be able to apply the recognition and measurement principles of IFRS, but with reduced disclosures. So that may be an interesting new standard in the future. Some discussion papers as well, just to be aware of. The IASB is looking at the accounting for business combinations under common control. Of course, in the UK GAAP, we have guidance for merger accounting for group reorganizations. So this is looking at situations like that. The proposals are currently looking not exactly the same as what we have under UK GAAP. So this will also be an interesting area if and when we do see a standard on that, because we do see a lot of course, group reorganizations. Also looking at business combination disclosures and the accounting and disclosures for goodwill and impairment. And it's possible we'll see the reintroduction of amortization for goodwill even, or possibly some other simplifications to how impairment reviews are conducted. And what kind of disclosures are required for business combinations after the acquisition takes place. So a few things that may be coming up in terms of changes to standards in the coming years. The IASB is also looking at an agenda consultation that's similar to, in a way similar to the periodic review for FRS 102 we just looked at. So this is where they are seeking feedback from stakeholders on what should be the priorities for IFRS standard setting in sort of the coming years. So that one is still available for comments, I believe, till the end of this month. So if you want to comment on whether the IASB should be looking at climate change or cryptocurrencies or something like that, or extractive industries, or a particular project should have more or less focus, then there is still a chance to comment on that as well. Okay, so that's all we had for an accounting update today. So moving on to narrative reporting, which, as I mentioned, has seen a lot of focus recently. I think recent developments like the COVID-19 pandemic, Brexit, climate change, these are all developments whereby companies really need to tell their story, how they are addressing what's going on in the environment, or what does that mean for their business. And so narrative reporting has been very important. So what we've seen just in the last couple of months is that the FRC, the regulator, has been looking into the quality of reporting and sharing guidance on how companies can improve reporting in these areas. So we're just sharing some of the key points on these for you. So first of all, the FRC lab published a report in July looking at reporting on stakeholders, decisions, and Section 172 reports. Now, of course, Section 172 reports are a relatively recent requirement, only came in 2019. So this has been, there's been quite a variety of different approaches different companies have taken to preparing Section 172 statements, which apply to large UK companies. So now we have some work from the FRC lab looking at the quality of that reporting across different companies, and also talking to investors on what is it that investors are really looking for, and how do they see what is the information currently provided by companies useful or not. So what the key messages coming out of this are that investors are very interested in this information. They are looking to understand how a company is progressing towards its purpose and long-term success. And to understand this, it's very important for them to have information about stakeholders and information about the key decisions that a company has made in the period. And in fact, the Section 172 statement is something that brings those two areas together. So what this report does is it's structured into those three areas and goes through looking at what questions do investors have, what's the information they would like to understand. There are lots of examples in all of the FRC lab and FRC thematic review reports. So if you are looking to get started in drafting these for your next annual report, then they are very useful to have a look at, and you might see something that it helps you consider which approach would work for your company. So information on stakeholders. This should include identifying who the stakeholders are, what's important to them, how the company builds and maintains relationships with them. Are there any risks to this relationship? What could make it suffer? And what is the company doing to monitor this? On decisions, strategic reports should include information about strategic matters, including significant decisions taken during the period, and try and link that to how that fits in with the company's purpose, strategic priorities. How did the company reach those decisions? Did they need to balance out different considerations, difficulties, challenges in arriving at those decisions, and what was the expected or actual outcome of the decisions? Now, both of these aspects, so information on stakeholders and information on decisions, feed into the core requirements, the expectations for what a Section 172 statement should be doing in explaining how the directors have performed their duties and considered the factors they're required to consider under Section 172. So In terms of the Section 172 statement, then, I think we have covered this before. There was an earlier document where the FRC lab published a tips document, which is a very easy to read, useful reminder to, I think, 2-page summary of some tips. And in this report, we refer to those same concepts as well. So just some key reminders here about Section 172 statements is try not to just make this a page explaining sort of the process around stakeholder engagement. Remember to consider all the aspects of Section 172 duties, including engagement with members and the long-term sustainability of the business and environment, community, all of the aspects. Definitely link your Section 172 or structure it around your principal decisions taken in the year. And sort of set it out in such a way as you explain how you considered all of the Section 172 factors and what effect they had on those key decisions. So you'll be bridging the information on stakeholders and decisions in this way. Certainly can incorporate this all by cross-referencing. There would not be a need to be duplicating information. And also think about making sure that you are linking all of this story to what you're saying in the rest of the front end about business model strategy, how the business does all of this and considers governance, culture, and explains where it's going in trying to achieve its purpose for long-term sustainable business and success. So take a look at those documents. As I said, they're examples from companies, so that will probably make it more particularly useful at the time you're looking to draft a Section 172 statement. Okay, the next report was on also from the FRC lab, and this is where they looked at reporting on risks, uncertainties, opportunities, and scenarios. Now, clearly, times like the COVID-19 pandemic, many companies have had to really focus on their risk assessment and risk management, risk identification, and possibly change how they do that. So this needs to come through and be explained in narrative reporting. Also, the increasing focus on ESG, things like government proposals to introduce resilience statements in addition to what we have now on going concern and viability. So that would be for public interest entities, at least initially. These all link in with reporting that may involve that involves considering risks, uncertainties, opportunities for the business, and also things like scenario analysis and stress testing. So that's why this area is topical and why the FRC lab looked at it, spoke to investors, and they did find that there seems to be a gap between what information investors are looking for and what companies are providing. So therefore, there is some room for improvement. This is quite a detailed report, so not able to list out all the suggestions made. There's a sort of chart there on the screen of kind of how the FRC lab structured, how they looked at this topic in terms of the angles they came from. But essentially, some of the key points to take away are that investors are looking for quite a lot of detail about not just what the risks are that a company has, so not just a listing of principal risks and uncertainties, but they're more interested or also interested in how you arrived at that. So what's the governance and process? What are the processes behind that risk assessment? What's the thinking behind it? Who's responsible? What do they consider? How? When? What are the considerations, the logic in deciding which risks are principal risks, or when they move in and out of principal risks, or change from being, if you're using different risk ratings, high, medium, low, or if a risk has increased or decreased. Just statements that a risk is increasing or decreasing aren't so helpful. It's more about why the company thinks that's the case. So scenarios and stress testing. We are seeing these in things like viability and going concern assessments, very much so during the COVID-19 pandemic. Of course, other areas, impairment reviews going forward, climate change scenario analysis. So this is sort of an area of reporting that's becoming more relevant and more frequently used. So, but not necessarily something all companies are familiar with. So this report is worth looking at for some suggestions on how to make good use of and how to describe in your annual report how the company uses refers to scenarios and stress testing. Uncertainties. So it's not just about the risks and the opportunities. There are also other uncertainties. And the important point here is that is to just acknowledge that there is uncertainty and to kind of explain the extent of that uncertainty for your business. Okay, final topic on those then was an FRC thematic review. So this is not from the FRC lab, but from another part of the FRC where they've looked at the quality of viability and going concern disclosures. Now, they have looked at this for companies with year ends between December 2020 and March 2021. So that's very much the annual reports that published around when the COVID-19 pandemic hit, and clearly reporting on viability and going concern was a significant issue and a reporting challenge at that time. So this is what this review focused on, but there should be many lessons from it relevant going forward, because the FRC is of the view that in general that there is plenty of room for improvement in these disclosures. So investors are, of course, interested in how companies have managed to navigate through the pressures and uncertainties of the pandemic and their journey, how they're working through that, what they expect from the future, and how they intend to maintain their solvency and liquidity. So information really here, the focus is on being informative with entity-specific and very clear but also concise information. There are instances of unduly lengthy going concern disclosure notes that may not be so user-friendly. So the FRC encourages this cross-referencing. So for example, cross-referencing between your going concern and viability assessment disclosures, or perhaps between front end and the accounts. And basically to focus on particularly the disclosure of the various assumptions used in these assessments. So whether that's the scenarios used in viability assessments, the assumptions used in cash flow forecasts for going concern reviews. So this is where the expectation increasingly really is for more specific, both qualitative and quantitative information about the assumptions the company has made. Do focus on consistency throughout, so make sure you're approaching the going concern assessment and the viability assessment are two different things for different time frames, but to the extent they are considering the same areas, the same risks and uncertainties, then the approach needs some consistency. Similarly, the consistency between how forecasting is performed for the financial statements accounting. Any significant judgments made as part of the going concern assessment do need disclosure. This is an IFRS requirement. So whether that's a material uncertainty or a significant judgment in concluding that there was no material uncertainty, if that was a significant judgment, it needs explicit disclosing. One area is that if you are setting out information about viability, the scenarios considered and stress testing considered on them, then it would be helpful to clearly map that to the principal risks that you're testing with those scenarios and stress testing. Explain the reasons for the period of time you've selected for a viability assessment. The FRC noted that 3 years seems to be very, very common, but perhaps some companies might want to think about 5 years instead. And yeah, those were actually the key points we wanted to share from this report. For all of these FRC reports, there's still one more coming up that Anthony's about to talk about. We do this, it might seem like there are a lot of them, but we do encourage you to take a look at some of these, because you will find many really useful practical disclosure examples from other companies out there when you are getting ready to prepare your annual report. Okay, so with that, I'll pass you over to Anthony, who will talk about sustainability and climate change reporting.
Thanks very much, Elisa. Good morning all, or good afternoon all now. Yeah, Elisa's couple of things just pick up from Elisa said there. Yeah, I mean we think these thematic reviews and lab reports are really powerful for two key reasons. One, it really shows where the regulator's mindset is, and the regulator increasingly is working in a very coordinated way across both policy setting, monitoring, and all the way through enforcement. And that's also links between the accounting, auditing, and corporate governance parts of the FRC. So getting a real understanding of what where their interests lie will really help you to sort of navigate the kind of interventions they might put forward. I think the other thing I'd pick up on is, whilst we talked here about, Elisa's talked about narrative reporting, and I'm going to be talking here about climate change and sustainability reporting. Also remember that consistency between the front end and the back end. And again, that is something the regulators are very keen on. So they will look to investigate financial statements where they think there is inconsistency between that and the story said in the front end. And similarly, the pressure they will put on your auditors to have considered the assumptions used in the front end and looking for that consistency throughout. So I think they use these FRC publications. They're full of really useful examples, really good indications of what good practice is, because it impacts greatly on their views when they come to do their own reviews and investigations. Anyway, moving on then to sustainability and climate change reporting, and this is quite clearly a very big year for the response to climate change, with COP26 to be held in Glasgow very soon. You'll have seen Boris Johnson speaking at the United Nations. His entire address to the United Nations was on climate change, and really setting the scene for the UK chairmanship of COP26. And COP26 is also a focal point for the delivery of new reporting initiatives related to climate change. So the first of those mentioned there, the set of the International Sustainability Standards Board. Now we talked about that a little bit in past webinars, but just a reminder that this will be a board that will sit alongside the IASB within the same foundation, but with the objective of setting standards for sustainability reporting. And the first of those will be on climate change. They are certainly trying to align their timetable with COP26. They will want to be making some announcements around that time. And so I expect us to see very soon, the finalisation of the IASB, excuse me, and perhaps even early sights of their first exposure draft on climate change. Why does that matter to us? Well, because IOSCO, World Bank, IMF, and in the UK, the FCA, the Bank of England, the PRA, they are all public advocates of this. And so we can see it coming into the UK first via listing rules. I was certainly seen soon after through legislation. Certainly that's what I expect over the next number of years. The other big development, TCFD reporting. So we already have the listing rule for premium listed commercial companies, but we can expect again very soon, perhaps again to align with COP26, and the extension of that to other listed businesses. And at the same time, we can also expect soon the legislation mandating TCFD for large companies, large private companies. So it's becoming a legal requirement as well as a listing rule, but expanding the scope of that. Exact scoping has been open to wide debate during this consultation period, but I think we will see something all the same. So that's looking at these, an idea of how much is going on, and this really is kind of just the tip of the iceberg. There's so much going behind each of these developments, but don't forget there are things we are already required to do. So what I'd like to talk through a little bit is the FRC's review of SECR disclosures. So that's streamlined energy and carbon reporting. Streamlined always seemed a little bit of a misnomer to me, given it was a set of new requirements, but and we'll see what good practice looks like in those. Clarify a little bit about those listing rules for TCFD. That will give us all a little bit insight into what TCFD requires. But then not forgetting, as I mentioned earlier, this link between the front and the back. Climate change does have an effect on financial statements, and not just for listed entities. And getting that consistency, that single response and approach to climate change in the front end and the back end. So we can move on, and I'll start first with the thematic review on the streamlined energy and carbon reporting. So I mean, when SECR was introduced in 2019, I mean, at that time I worked at the FRC, and I have to say, I really thought the legislation was a bit of a dog's breakfast, to be honest. Very difficult to follow exactly what the scope is, not particularly user friendly, to mixing my metaphors a bit there, but for preparers, difficult for preparers to really understand what was required of them, where they fell into the legislation, where they didn't, what the extent of their responsibilities were. And with that, it's not a surprise that to date it isn't an area of particularly high quality reporting. And I think this particular thematic review by the FRC, and remember, this is by the FRC's monitoring team. This isn't the lab looking to just improve, strive for better practice in the future. This is the monitoring group there. So really gets at the heart of their kind of enforcement teams. What they have found, and we'll go through these in a bit more detail. Okay, most complied with the minimum statutory requirements to some extent, but still some sort of failings there. We'll look at some of those. A sense, though, that these disclosures have been made almost on a purely compliance basis. It's very difficult for anyone to put them into the context of the rest of the report. How do we make these understandable and relevant to use in their decision making? As I say, I don't think that's helped at all by the way the legislation is drafted. But look, I think this review will certainly help you improve yours. And again, like the FRC increasingly do, really trying to identify good practice. I mean, this review involved covering 27 entities, and not just those with significant emissions. Yes, there was a bias towards them, but not only. It looked beyond the obvious sort of suspects for having high energy use and thereby high carbon emissions. And it covered a range of sizes of business. They weren't just looking at the very large. They were looking at, or just listed, looking at large private companies, looking at AIM-listed companies, trying to determine, what good should look like. So we're moving into some of the detail on it in terms of their key findings. On emissions and energy use, where we are required to disclose the amount of emissions and the energies that the energy consumed. There is difficulty, as I mentioned, about the scoping of the SECR disclosures, and they can change depending on the nature of your entity, whether you're quoted or not, for example. And it is very difficult for a user to really understand, let's say from a just by the legislative requirement to really understand what is the scope for you. So which entities have been included within the disclosure, how is that boundary set, and allow people to understand which part of the business, if it's not all of the business, has been covered here. Many entities are moving towards some level of assurance over the SCCR disclosures. If we look forward to the BEARS reform of audit, I would expect to see that will expand further. But at the moment, yes, it can be done voluntary, but it isn't clear to users what that level of assurance is. So if you do look to get external assurance or internal assurance over it, what's the nature of that? You know, is it what? How limited is it? What's the nature of the confirmation that's been given? We're also supposed to disclose the methodology to calculate these emissions. There's a lot of judgment in determining the appropriate methodology, capturing the data, knowing what to measure, and ultimately reporting. And on this, yes, it's one of the key areas is this boundary. How have you gone about determining which parts of the businesses are covered by it? One thing which is often presented in a way that makes it very difficult to understand is the need to provide a ratio of the emissions to some quantifiable factor. The idea here is to sort of provide a context for the level of emissions by reference to the scale of your activities, the scale of the business that's captured by the disclosures. So, you know, it might be to do with the revenue, it might be to do with unit output, it might be to do with expenses. But whatever it is, you should be trying to explain why you've chosen that. Why is that a good indication of the scale of the business and the drivers really in the business of emissions? Because you need to try and get that ratio in hand, because the driver will still be there. How do you reduce that ratio such that there's lower emissions for that driving factor? And that should be the basis of the explanation. And if the ratio can't be derived easily from the financial statements, from other information that's provided, then show how it is reconciled or explain the calculation. Moving on to more findings, in terms of measures of energy efficiency, you know, most entities will be looking to manage their energy usage, and thereby should be capturing data on energy efficiency. But the one thing that can happen is there's this whole list of energy efficiency initiatives, and it ends up being a little bit like a real sense of kind of whitewashing of saying, look, these are all the wonderful things we've done, but actually some of those may be very small initiatives. You know, really trying to focus on those principal measures that will really drive energy use over the longer term. Lastly, we see this all the time in FRC's output. You know, how does these disclosures on SCCR link to what has been said generally about sustainability, climate change, etc.? You know, trying to avoid duplication through cross-referencing, but trying to get a single narrative. You know, if you're setting certain targets around emissions, how do they fit in with your broader sustainability objectives, and ultimately how do they coincide with your business model and strategy as a business? This idea of allowing users to really join the dots. You know, if you're looking for good practice, the reports will help you. Details provides ideas where companies have gone for additional voluntary disclosures. Scope 3 emissions is where you start looking across your entire supply chain globally for the level of emissions. Very difficult to do in practice, but certainly some are aiming to try and capture that information or some element of it, and as long as and providing, you know, context for what they have achieved there. Looking as well at targets. You know, if energy efficiency and carbon reduction is something you are stating as being an objective of the business, well then quantify those, provide the objectives, provide the targets that you're aiming for, and show the pathway over time towards achieving those. And furthermore, the good practice identified where, this is seen as part of the TCFD reporting or consistency with it, and explaining the process towards better TCFD reporting, which is a good segue into the next slide. I'll talk on subsequent slides on the exact requirements currently under the listing rules. But what I'd like to do first is just really look at this slide because whether requirements are set, they're made by reference to these recommendations in the TCFD. Now, first thing to note is these 4 pillars. When many entities are told about TCFD and the reporting requirements, they think, oh well, this is an issue of reporting. I'm going to have to find some data. I'm going to have to collate some information and then put it in the front end. Yes, you have to report and we'll see these 11 disclosures, but those disclosures are around these 4 pillars that go far deeper than reporting. And governance, to what extent is climate change being incorporated into the governance structures of the business? Is it a topic for the board? Are there risk assessments being performed around it? How is the process of preparing your company for a future that will be different? This isn't just about, do I affect the climate? This is about how legislative changes to achieve climate reduction will impact on you. If we look at it as individuals, if we're going to achieve climate reform, the reduction in CO2 required to meet climate targets, it's going to change the way going to change what we eat. It's going to change the way we heat our homes. It's going to change the way we travel. Similarly for businesses, it will change what they sell. It will change what customers want to buy. It will change the way we're allowed to manufacture, the way we're allowed to distribute and procure. So this is something that will have impacts across the business as regulation becomes tighter and tighter. You need to think about how you're managing that. Also got to think about how the strategy, the business strategy, is going to adapt to net zero, or certainly hugely reduced, a future with hugely reduced carbon output. So how do these risks impact on what you think your future objectives will be? How does it change the nature of the business you need to be over the coming years? So incorporating it into your financial planning, into your business strategy. A pillar on risk management. Yes, some risks are immediate if you are a high energy user, but also think about where are your raw materials coming from? Is that area of the world subject to physical risks as the climate changes? Is the product you manufacture, are those materials ones that are likely to be interrupted, either because of physical risk or because of regulatory change on what can be used? Mapping out that future risks and future opportunities, because for many businesses this will offer new opportunities, new products to sell, and make you more attractive to investors who are looking for green opportunities. Then for all of that, what are the metrics, what are the targets you are using to monitor your performance and towards a future which is more aligned to managing the climate change. So they're the 4 pillars. It begins with governance, it begins with board decisions, and it begins with understanding the future of the business. Only when you have got to that point of thinking through those can you even begin to meet the TCFD disclosure requirements. And so we see that boxed, that area where the dotted box around it. You know, those 6 disclosures, these are ones, as we'll see on the next slide in a moment, that that are identified through the listing rules as being, we really think you should be able to do this now. This isn't something you're going to have to develop systems. You should be able to say how these things are incorporated now. It might be when you stop and reflect that you realize these aren't very well incorporated. So how are you going to get there? Provide some transparency about the journey you're going to go on to sort of incorporate these things. At the other end of these 11 recommend disclosures, the 3 with red stars around them, I mean, these are ones which will really take a lot of work just to be able to capture data, to be able to do it. I mean, I would highlight particularly the recommendation C under strategy, you know, trying to map out the scenarios, what the impact of a 2-degree limiting all temperature rise to 2 degrees, if that's the global target, to work out how that will impact on you and your business, and thereby start doing scenario planning, is very difficult. And the truth is, very few are far advanced on that, but over time, the FCA will expect you to reach that level of complexity and sophistication. So just move on to the next slide then, talk about the listing rules. You know, exactly what are they and what are they requiring? Well, you know, for this year, so for December 2021 year ends, the annual report for this year should explain explain whether you've made disclosures consistent with TCFD, namely those 4 pillars and those 11 recommendations. If you've not made disclosures, explain why, and the journey you are going to be on to be able to achieve them, and indeed the time frame for them. You know, investors won't be expecting you to be there yet, but they would expect honesty and transparency and a commitment to get there, and that's really what investors are looking for. And then, you know, specific requirements to highlight to people where the disclosures can be found. You know, beyond the listing rules, there is a additional guidance which tells you to, you know, dive deeper into the TCFD. You know, TCFD has those 11 disclosures, but then has detailed guidance, detailed annex that expands on them and provides clarity about what is required. Now, clearly, the extent of it will be of the disclosures is partly a function of the business and where you are and the sectors you operate in and your supply chains and your customers, but it will affect everyone in some extent. I think that's the lesson we've got to learn when you see, you know, the Prime Minister speaking at the United Nations on the scale of the issue ahead of us. No person and no business is going to be exempt from the impact of this, and we have to think it through to understand how we can maintain and create value as a business in the future. Yes, that focus was on the listing rules, but as I mentioned earlier, I'm sure BEARS will legislate to make this or something similar based around the 4 pillars and the 11 disclosures, something similar, a legal requirement, and that will extend beyond the those covered by the listing rules. And you know, so now's the time to start thinking that through. And as I say, it isn't, but don't think about it. Don't think it through because this will be a reporting requirement in the future. Think this through because these are real risks, real impacts for all businesses. So just move on. You know, to get started on that, you know, it is a journey, but you do need to begin with governance and allocate responsibilities. It is about getting on the board's agenda. It is about asking basic questions about, okay, if I think about my supply chain, my customers, the nature of my products, you know, how could I be impacted by this in the coming years? And how do I make my business fit for purpose in the new environmental and importantly regulatory and legislative environment where we will be operating in the future? Explain what your plans are if you haven't achieved them yet, and show how you're going to achieve them. That's what investors and other stakeholders will be looking for. But we've just got to really get started. as I say, some of these elements, scenario analysis and some of the metrics and targets will be the most challenging. And because systems will need to be in place, you need to think about controls over that data collection and data analysis and reporting. My expectation is some of those will be done in a slightly lighter touch in the BERS in legislation, but I may be wrong. But certainly if you're premium listing, you need to be on track and thinking about what information collection systems you need to do that. Okay, that's about TCFD. I'm not going to go through this slide in much detail, but it isn't just about the front end. All of those issues about real life issues, about physical risks and regulatory changes, differences to the way we'll run our business in the future, they are clearly and ultimately will have economic consequences. Well, if they ultimately have economic consequences, to some extent, they will start being reflected in the financial statements. Even if at the moment it isn't going to have a material effect on some of these things, such as the current value of inventories, and you've got to start thinking it through. And it certainly might start having an impact when you start looking at your longer life assets and whether they are impaired. The IASB did issued some useful material last year. We've covered it in some before, but it isn't just a narrative point. Finally, just to point you in, finally on sustainability anyway, just to point you in the direction of some toolboxes that might just help you start on that journey, and some guides that we have. After this webinar, we will send you the slides and links to these, but they can easily be found on our global website, BDO.global, where we have helpful guides there already, sustainability framework, understanding the business case for dealing with climate change and the effects on the financial statements, and that toolbox will fill further over time. But you can access those and BDO.global, but we'll also send you the link after. Okay, final little piece then. I'll go straight into here. ESEF. So this is for companies with a full listing, but what this is requiring is basically it's the start of moving from thinking of reporting as a paper product to being one which can be directly accessed and manipulated electronically. Those companies who fall within the scope of DTR, this year again, December 2021 year ends, so your annual report for that period has got to be produced in an XHTML web browser format. So it's got to be available electronically, and embedded in that electronic format will be tags of the kind that we normally refer to as XBRL. And there is a taxonomy which needs to be applied to do that. That will extend further next year to expand that from primary statements as it is this year, but to the notes to the financial statements. And I would imagine in time as well, it could well extend in future years to the narrative reporting, but we'll see how that develops. The truth is, for those of you who are required to apply this, my guess is very few of you have moved far towards being ready to implement it. And I say that because if I move on to the next slide, the FRC recently issued a survey on preparedness, and in fact next month they will also issue a more detailed early implementation review. But the truth is, nearly a third of those companies they spoke to who will be required to do this had no awareness of it. Very little progress made towards actually implementing it. But those who were further forward, some solutions included there, creating a separate, it's still continuing with a PDF file, but producing an ESEF for filing requirements, the electronic internet readable version will go to the stock exchange, but still looking to use PDF forms elsewhere. But confusion still about what exactly the extent of the requirements. And I think the important point really is this second last one. Almost certainly you're going to need some kind of intermediary to help you here. There is only a limited pool of resources in the market to help support entities do this. There's only a limited number of providers, and those providers aren't just going to be supporting the 1,700 UK preparers, but they've also got contracts across the entire Europe where this is being done. So if this is relevant to you, if you need to apply this, please start early, and please make sure you move forward your project to implement this and seek any guidance you might need. Okay, that's all. I think we're just about on time. This time round, yes, there wasn't much on nuts and bolts, double entry. But right now, the big story is narrative reporting and sustainability reporting, and it will continue to be for the next few years. It isn't just about new requirements, it's about an increased regulatory focus, and in time, it will also be about assurance around it. And to ultimately deliver on high quality TCFD reporting, you've first got to embed it in your governance processes. So time to start is now. Anyway, I hope that was useful to you all. If there's any further questions, we will look to respond to them straight.
We might, Anthony, sorry, we might try and answer. There was just one question you might try and answer just to finish this off if the people are still with us. So there was one question was whether you've got any thoughts on how far BEIS may seek to extend TCFD beyond listed companies. I thought you'd have a few words on that one.
Yeah, absolutely. I mean, it's a difficult question for one key reason is other parts of the reform of reform, which is currently on in terms of the bigger audit reform, will include trying to come up with a new definition of public interest entities, and thereby the scope of that is changing. So at the moment we have kind of multiple proposed scopes for different elements. Now I think that the BEIS are under a lot of pressure to not overcomplicate things and try and set out as fewer sets of populations that apply different regulations as possible. So with that in mind, I would expect what we would end up with is all publicly traded businesses. I think we will also end up with all with large private companies. Exactly what live is, exactly what large is open to debate. But I think we will be looking at a measure of either a mixture of revenue and employees. We will be talking, I would imagine, in terms of at least tens, perhaps low hundreds of millions in revenue, but hundreds, if not thousands, of employees. But if that sounds vague, it's because there are so many competing hierarchies at the moment. We don't really know where they land. But large privates, definitely. Exactly what large means is still open to uncertainty. I hope that helps, although I couldn't be 100% precise, but certainly large private companies involved. Is that all then?
There was just one other question on section 172, which I could comment on briefly, or Anthony, if you'd like to. So if you're in the situation of having subsidiaries, subsidiaries in a group with the suggestion that they have no other stakeholders except the ultimate parent, the revenue creditors, then why do such companies need to prepare a section 172 statement? And to answer that, I was going to say that, well, that's where you do need to remember that the section 172 does include a number of those factors. So it's about acting fairly between members of the company. That might not be such a critical issue if there's only a single shareholder, but some of those other considerations are still important for the directors to think about in reaching their key decisions, and it's those decisions that are relevant to that board of that entity for the particular period that should be discussed, but you can reasonably expect that the extent of detail in a subsidiary or intermediate holding company's Section 172 statement will be different to something from a large listed group, for example. I don't know if you had anything else to add on.
Yeah. I mean, I think you've absolutely nailed it on a head. You know, the Section 172 is duty requires you to have regard to employees, to business ethics, to the environment, to the community. So it lists stakeholders and issues that go beyond just direct users or the most obvious users of the accounts. And that responsibility lies with directors of each and every company. I mean, the reality is that the legal separation and the legal allocation of responsibilities to individual company directors perhaps doesn't really reflect the reality that often subsidiary decisions in subsidiary boards have been directed by the parent board anyway. And that may be the kind of economic and commercial reality, but for the purpose of government writing this legislation, it isn't the legal reality. The legal reality is that directors of that company, individual subsidiary company, are responsible for it, do have their own duties, and those duties are related to that individual company. So I do take the point about less users. I do take a point that in essence, many of their decisions are being made for them further above. And you know, when I was at the FRC, we raised some of these practical realities, but you know, the response was no, but that's where the legal responsibility lies. So we cannot ignore that. So that's you know the story of how we landed where we did. So if there's no more, I don't think there are. Is that right, Elisa? Nothing else?
Nothing else.
Okay. Well, look, I've now run over ever so slightly, but please know we'll send you the slides, we'll send you some links to those guides, and have a very enjoyable afternoon. And we'll see you again. Speak to you hopefully again in December.